Hey guys, welcome back to the channel Let's Make a Mill, as well as my blog letsmakeamill.com, where I'm documenting my journey towards $1 million. In today's video, I just want to give my take on an investor update that Fundrise had published. They're calling it their first half of 2020 performance analysis. There's some key points in here that I think any investor should be aware of when they're investing with Fundrise or if they're thinking to invest with Fundrise. And this is just my take on it. I'm not a financial analyst, a financial guru, or anything like that. I'm just some guy on the internet that's doing whatever it is that I do. Um, Again, this is all just my opinion. So without further ado, let's get into the video. So, first thing about their investor update is that they compare themselves to the Vanguard Total Stock Market Index as well as the Vanguard Total REIT Index, VTI and VNQ. All right, these are two publicly traded exchange funds that are available on the stock market, and they just compare their performance with their performances. So, looking at the graph or chart, whatever, you can see that uh, Vanguard had returned a positive 2.41% in the first 6 months versus a negative 4.91% from the Vanguard Total US Stock Market Index, and even more so, a negative 15% from the Vanguard Total Real Estate Index. All right, so Fundrise, in its own regards or its own respects, it actually performed better than these other two asset types, um, over the first 6 months of 2020. So we're going to go down. Oh, here it is right here. Um, yep, VTI and VNQ if you want to look up those tickers. These are two great exchange traded funds that are available out there. Again, I can't speak highly enough of Vanguard. Anyways, moving forward, here I highlighted a couple things on this investor update, and I'll just kind of give you my take on everything. So the first key takeaway. This top line performance is supported by strong fundamentals, with a number of our stabilized properties actually experiencing positive rent growth in spite of the larger economic contraction. All right, so two things here. One, the larger economy at a glance, I guess, had a huge contraction due to the pandemic. People lost jobs, people were jobless, businesses shut down. Um, the whole economy basically came to a screeching halt. And point number two, throughout all this, Fundrise in their stabilized apartment portfolio, they still saw positive rent growth, which is fantastic because in my own portfolio, like I've said, on my M1 finance, I'm the biggest position or the biggest slice of the pie that I have is apartments. Avalon Bay Communities, Equity Residential, Camden Property Trust, Essex Property Trust, or I'm sorry, Essex Apartments. I forget ESS. But anyways, the apartments is a large portion of that portfolio because I believe that apartments is very safe in that the total returns and the amount of growth that it has, the growth potential that it has. So I'm invested long term with those REITs. But back to Fundrise, in their own apartment portfolio, they've experienced positive rent growth, which is crazy because, a lot of people didn't have jobs or they were jobless, or they lost their jobs during the pandemic. So it's kind of uh, crazy that they're still experiencing positive rent growth during these times. A second point, we have chosen to resume normal operations of the redemption programs and expect to ramp up new acquisitions through the rest of the year as opportunities present themselves. So again, if you saw my last video of Fundrise, the management took it upon themselves to stop or halt the redemption program, which is a big deal because as the pandemic was happening, people were trying to move their money out of investments into cash or into gold or into bonds, into safer assets. But Fundrise had halted that, so the greater community, the greater investor community at large, wouldn't suffer. And Fundrise did this because they felt it was in the best interest of not only themselves but their investor community to have a larger cash position. They also expect to ramp up new acquisitions through the rest of the year as opportunities present themselves. You know, Fundrise again had this huge cash position, and as real estate is taking a hit during this pandemic as well, is creating new opportunities. Just like in the stock market, is creating new opportunities. So Fundrise is holding on to a large position of cash so they can invest in new opportunities, i.e., you as the investor get to reap those returns later on and down the line. Another point that I think is very important when people are investing in real estate, they need to know real estate is, as we like to reiterate, a long term investment that should be measured in years, not months or days. When you're investing in real estate, you're not investing in the stock market, right? It is not like a stock where it goes up and down, and crazy up, like 20%, the following day, 100% the following, whatever. You know, real estate is very stable. It is not correlated to the stock market, and it is not volatile. Um, so you have to really measure real estate in years, not months or days. And if you're invested in real estate, I'm sure, can appreciate this fact. But moving on. So here's just a quick point. In short, over the first 6 months of the year, Fundrise net platform returns have averaged approximately positive 2.41% in comparison to negative 4.91% for stocks as measured by the Vanguard Total Stock Market ETF VTI, and negative 15% for public REITs as measured by the Vanguard Real Estate ETF VNQ. All right. They're using these as kind of a benchmark to compare their platform to, as I said earlier, and they've actually had a positive net return versus the stock market. And if anyone has a personal capital account and invested in Fundrise, can say the same thing. I do. And when I look at my personal capital account, all my stocks are going up, and then boom, big dip. But Fundrise had remained pretty stable through that whole period, so that was pretty cool. The only thing is that if I needed to redeem the cash, I wasn't able to. But again, I'm invested in the long term. Here's a quick graph of what I was talking about with my personal capital account. We're in a bull market, and then here came the pandemic, and it just constantly went down, went down, went down. But Fundrise had remained pretty stable through this time period because real estate is not, volatile. Like I said, it's not traded like a stock. So it remained pretty stable through this whole pandemic. So moving on real fast, another interesting point. In addition, we also made the choice to reduce dividends over the second quarter based on the belief that rental income would decrease at most properties. Very key point. In nearly every asset type, whether it be retail, office, or multifamily, tenants were quickly expressing concerns about their ability to pay their rents, and we concluded that holding back more cash would prove valuable, both in terms of allowing us to be flexible landlords in the midst of a health crisis. Together with the decision to suspend redemptions, these actions created what we believed was the closest thing to a fortress for our investors, positioning us to withstand the worst potential outcome that we could imagine. Okay, so there's a lot going on in this paragraph right here. Um, they predicted. Okay, this is a very responsible direction that management took. They predicted that rental income would decrease during this pandemic because everyone was losing their jobs and everyone was becoming jobless, right? So there goes, all the rental income for apartments. And they're saying in every asset type, whether it's retail, office, multifamily, uh, all their tenants were expressing concerns about paying their rents on time. People were losing their jobs, like I said, and you can't pay the rent if you don't have a job. And there was no plan of action. There was no stimulus checks. There was no plans for that at that moment. So again, it was very smart by management to make these conclusions based on the total environment that was going on. So, second thing, tenants were expressing concerns about their ability to pay rents, and we concluded that holding back more cash would prove valuable, both in terms of allowing us to be flexible landlords in the midst of a health crisis. So, important thing when you're investing in real estate, right, especially in like single family or multifamily homes, you need to have 6 months of cash available, 6 to 8 months of cash, right? Cash reserves in case these kind of things happen where the tenants don't pay. You need to be able to still pay that mortgage. Okay, so Fundrise again made the right call by keeping cash available just in case something was to go wrong with their properties, with the portfolio. They were still able to hold this cash and deploy it in case of an emergency. So again, another responsible act by Fundrise Management. Together with the decision to suspend redemptions, these actions create what we believe was the closest thing to a fortress for our investors. Again, they're just reiterating that, they're keeping the investor in mind, the greater investor community in mind, that they had to harm a few in order to save the many. They had to stop the redemption program, and effectively, when they stopped the redemption program and they had a huge cash position, they created what it was closest to a fortress balance sheet as possible, and keeping their investment safe and keeping the investor community safe. you know you can find this kind of uh, management philosophy, if you will. You can find this with like Avalon Bay communities. Again, they have like a rated A grade fortress balance sheet. All right. So moving on. So as you can see, uh, stabilized apartments makes up about 26% of their overall portfolio. Again, if you look at my M1 finance portfolio of REITs, you'll see that apartments make up a huge chunk of the pie. So another important key takeaway: our confidence in this asset type is driven by the belief that even in periods of economic distress where people are forced to cut back on discretionary spending, they still need a safe place to live, which creates a baseline level of demand, particularly for well-located and reasonably priced apartments, a concept we've shared often in other discussions of our investment strategy. So again, they're investing in apartments. They believe that apartments are safe relative to other asset types or other types of real estate. Everyone's always going to need a place to live. And I agree with Fundrise's direction in investing in apartments, and it's keeping investing in stabilized apartments as well. Because as they have the income from their rents coming in, they can work on the other types of asset classes that they have within their portfolio. So we've actually seen demand for our apartment properties increase during this time, driving continued growth in rental income as more and more individuals choose to move to Sunbelt cities like Orlando, Jacksonville, Tampa, Charlotte, Dallas, or Nashville. All right, one thing to note, and this is just kind of me thinking about it. You have San Francisco, you have Seattle, you have Los Angeles, you have Boston, New York. These are high cost of living areas. All these people are leaving these areas to look for jobs elsewhere in growing cities, cheaper, lower cost of living areas. So Fundrise is trying to get ahead of that curve by purchasing apartments and investing in apartments in those areas. Again, a very, very smart, smart investment strategy. So I agree with that, and I do like that they're investing in these areas and trying to think ahead, because as people are leaving these, big cities to look for lower cost of living, it's just, it's a no-brainer. Just a quick personal story. I used to live in Boston, $50,000 a year salary, and my apartment that I lived in was a two-bedroom apartment. I was living with a roommate. The rent was almost $1,900. All right, $1,900. That's a lot of money, for a two-bedroom apartment, and we lived in a very nice area too. But you know, $50,000 somewhere else, I could have rented a whole apartment for myself. You know, um, for like maybe even less than 900 bucks. So it's just some. I could have rented a house in some areas. So again, just some food for thought, I guess. Uh, and I forgot to highlight this, but this is also very important right here. So their stabilized properties are comparing last year to this year. Um, Occupancy, they had 95.1% occupancy rate, and then this year they had 93.9. Delinquencies, last year they had 1.5%, and this year they have 5.0%. Okay, there's some important information here. Rent growth 3.9%, positive 2.4%. EQR, which I am invested in, uh, there's EQR, and there's like one or two more other companies that were posting their rent income, right? And they were somewhere between 90 and 95%. And here it kind of like tells you all the information, but people, it didn't mean that people weren't paying their rent. It's just that they were delinquent on paying their rent. So maybe they were, come, May 1st, you had to do your rent, but you couldn't pay, but you were able to pay May 7th or May 15th, right? So people were still paying their rent, which is a big deal. So, the thesis for apartments, for hoarding cash, suspending the redemption program, was so that they weren't sure people were going to be paying their rent. And as time went on, March, I'm sorry, April, May, and June, people were still paying their rents, right? So it kind of removed that belief that they need to hoard this cash because no one's going to be paying rent because no one's sure what's going to happen during this pandemic. So EQR posted that people were still paying their rent, not still posting that people are paying their rent. So that's all good stuff for the apartment people who are investing in apartments. Um, Again, additionally, unlike many public REITs whose portfolios are concentrated high-end apartments in gateway cities such as New York, Chicago, Boston, San Fran, our focus has almost exclusively been on reasonably priced apartments in high-growth cities from the southeast through Texas to Los Angeles. So again, kind of that Sun Belt that they're talking about. Uh, People are moving away from these cities because the cost of living is just way too high. And I would not be surprised if, tech sectors and things like that start to grow in these other cities, away from the Los Angeleses, the Seattles, the Bostons, etc. All right. Moving down, there's another point. Just want to quickly point this out: the compounded annual returns. So, Fundrise, as you can see, over the past 6, 7 years, I think they've been posting pretty good results, right? Um, Last year, 2019, the stock market had a huge bull run. 30%. If you're just invested, into a S&P 500 index or the total U.S. stock market index, you would have returned about 30% that year. Insane, right? Crazy, crazy bull run. I think the V&Q index, or like the total U.S. stock market index, returned. I think it was like 28, maybe 26%. Um, and Fundrise compared themselves to that, and they were saying, again, taking a look, yes, they have outperformed us, but taking a look, you got to look at Fundrise's overall performance, and they've been pretty good as a non-traded real estate investment trust, you know, versus V&Q that is investing in, like, I forget the number, but it's investing in every REIT that's on the index, So again, I think Fundrise, it performed very well during this time period. At the beginning of 2019, at the end of 2018, if anyone was invested at that time, remembers that there was a huge correction of some sort, a dip, and at the beginning of 2019, you know, both the indexes were completely negative. Again, Fundrise is doing well, but the two indexes were negative, and then that's what started this bull market into 2019, and then starting in 2020, we're doing very well, and then here comes the pandemic. But I just wanted to point this chart out. So I highlighted this in purple, because I think this is something that people should know, or definitely at least take into account. Uh, Fundrise has chosen to resume normal operations of the redemption programs effective immediately, including processing all outstanding redemption requests in the funds that were on hold, with proceeds expected to be distributed over the next 2 to 3 business days, right? So, what they're saying is that they are now allowing the redemption program to go through because their thesis about holding cash and suspending the redemption program was proved false. Their idea that they need to hoard all this cash, just after seeing how the markets and how everything kind of turned out, they're like, okay, so now we can start releasing cash because it's a safe, less risky, less volatile environment now. um, I think this is a big deal because Fundrise management is being responsible. They're telling their investors up front that, hey, we had to suspend all these redemptions because of this, right? Because of the pandemic. And now that the pandemic is coming to a new normal, and people are going back to work, the economies are starting to reopen. Now we can release those redemptions, or we can reopen the redemption program. Again, this is just Fundrise being responsible to their investors, right? They're not trying to scam anybody. They're not trying to, steal money from anybody. They're being responsible in how they act. All right. So again, I think that's very important, especially when you're investing with any company, that the management is very focused and they keep the investor at mind. All right, or keep the investor in mind, I should say. Um, so again, just a point that I wanted to make you aware of. And then, of course, this is just some legal mumbo jumbo, but it is all, excuse me, it is also worth noting that per IRS regulations, our e-REITs are required to distribute at least 90% of their taxable income each year, meaning that even though we've been conservative in our dividend declarations up to this point, to the extent that we have not met that 90% threshold as a result of holding back dividends, we may catch up on income distributions towards the end of the year. So I think what they're really trying to say, I mean, it's pretty blatant what they're trying to say, but REITs have to pay out 90% of their dividend income, right? Or their taxable income, right? From all the rents. So they have to pay out 90%, which is, pretty cool, because you as an investor, you get that in the form of a dividend. During the last 3 months of this pandemic, they had to place everything on hold because they wanted to keep that cash. But they still have to, by law, release those funds. So if you looked at my Fundrise account, on a $17,000 investment, I think I only got like $130 for a quarter, which is far less than their 8 to 12% that they tout for long-term returns. But they're going to release more funds as the year goes on. So again, I was never worried, and I'm not measuring my dividend income off of, or my dividend income from Fundrise as their performance. I'm going to measure it as long term, 5 to 10 years. So again, I think this is very good what Fundrise did, and they even posted it that they're going to be releasing more funds in the future. And that about does it. I just wanted to make this video, give you my take on it. If you're not invested with Fundrise or thinking about investing with Fundrise, these are very important updates that they release that you should be aware of. Again, I can't speak highly enough for Fundrise. They have a very solid management team. They're very forward thinking. They've made investing in real estate very easy for the non accredited investor. And anyone can invest in real estate. It used to be only that for people who had a lot of money or a large cash position, and now with crowdfunding real estate, companies like Fundrise allow you to invest in real estate with something like $500. Of course, you can invest in the stock market into REITs, but again, you have to think about the volatility versus non-volatility, tax benefits, things like that. So, or there's really no tax benefits, but yeah, you have to think of things like that, liquidity versus non-liquidity. So I hope you enjoyed this video. If you did like it, show me some love down below, comment down below, let me know what you think. Are you invested with Fundrise? Are you not? Is there any questions you have? I can answer them as best as I can. Subscribe to the channel. I also have a blog where I discuss things that don't make it into a video. Letsmakeamill.com. If you haven't checked it out, go ahead and check it out. And hope everyone's doing well during these times, and happy investing. Thanks for watching.